That's absolutely a risk, and this is part of the sort of wall of worry I think that the market sort of deals with, right? There is that sort of tail risk out there that the Fed has this all wrong. They're going to keep interest rates, high for too long, and then when it does come time to cut, they're just going to be behind the curve, and that transmission mechanism is not going to be quick enough to save us from that sort of downturn. I guess what I would say to that is, simplistically, we're about as far away from recession right now as it's mathematically possible to be. So I do think the Fed has time, and they just want a little bit more time for those high interest rates to play out, to cool the economy a little bit more. I think we're close. I mean, we're talking, a month or two rather than more than that. So I don't think I don't think we're too far away.
I'd like to welcome Ben Laidler back to Wealthion. Ben is the global market strategist at eToro. Ben, welcome back. We're glad to have you.
Yeah, good to be back. Thanks for having me.
Absolutely. So how are things over in London? I know here in New York it's hot, and actually we got a little reprieve yesterday, but it's going to get hot again.
It is hot here. We are geeing up for our own election next week. So, there's plenty going on.
Yeah. So I just want to ask you, usually I ask you about the present economy, and I know the European Central Bank has cut rates slightly already.
Yeah.
Here in the U.S., they're still looking at numbers. What's your view on the U.S. economy? What are we looking at? Is it still robust as everybody thinks, or is it starting to slow?
Yeah, it's starting to slow, but not by much. I think this is still a Goldilocks macro environment, certainly as a stock investor. The latest GDP nowcast for this quarter's GDP growth in the US is 3%. That's well above the long-term average. We're generating a couple of 100,000 new jobs a month. The latest PMI is at 54. That's very expansionary. Those are really strong numbers. Now, it's not quite that good. There are some pockets of weakness. There are pockets of slowdown. Frankly, we want to see that, but it's pretty glacial. But it's probably also enough to keep the door open to interest rate cuts later this year. And it's that sort of combination. Yes, we've got less interest rate cuts coming, but they are still coming, combined with this strong enough economic environment right now, which is giving us decent earnings growth and making any sort of talk of recession basically wasting your breath at this point.
Yeah, we have some numbers coming out later this week. PCI is coming out, I think, Friday.
Yeah.
There's the unemployment numbers coming out also, I think, on Thursday. Unemployment here is touched about 4%, which is something I guess the Fed keeps an eye on. They don't talk a lot. They talk about the CPE, the PCI. They don't talk a lot about unemployment, but they keep an eye on it, and it has ticked up. And I'm going to guess that it might continue to tick up a little bit. Do you see the unemployment starting to become a factor? Because obviously fewer people working, and it's not by much, but fewer people working are going to spend less money, obviously.
Yes, and retail sales have absolutely slowed. And if you scratch the surface of retail sales, people are spending their money on different things. They're spending, less money on the sort of big ticket, credit sensitive luxuries, and they're spending, more on those sort of staple goods. So you scratch the surface, you can absolutely see there's some stress out there for the consumer, admittedly the sort of lower income consumer, but it's absolutely there. But, we're still posting a couple of 100,000 new jobs a month. This is still a very healthy labor market. 4% unemployment is still very low in the greater scheme of things. And I think this all means that the Fed feels it is in no need to rush here by cutting, interest rates. It can always do more later. That's the sort of Fed put that I think is giving the market some comfort here that inflation has come down enough that if the economy does cool quicker than expected, the Fed can cut interest rates quickly and aggressively. But it's a little bit of an embarrassment of riches right now. I mean, the economy is running reasonably hot. Inflation's doing just about enough to keep the door open to rate cuts. And the Fed can, frankly, I think, take its time at this point.
Is there a slippery slope where it could, numbers could come up in a lot lower, or in showing that inflation is coming way down, whereas obviously the Fed doesn't want to trigger a recession. But is there a slippery slope with playing with this number, or playing with a rate cut, or waiting for this?
Yeah, that's absolutely a risk, and this is part of the sort of wall of worry I think that the market sort of deals with, right? There is that sort of tail risk out there that the Fed has this all wrong. They're going to keep interest rates, high for too long, and then when it does come time to cut, they're just going to be behind the curve, and that transmission mechanism is not going to be quick enough to save us from that sort of downturn. I guess what I would say to that is, simplistically, we're about as far away from recession right now as it's mathematically possible to be. So I do think the Fed has time, and they just want a little bit more time for those high interest rates to play out, to cool the economy a little bit more. I think we're close. I mean, we're talking, a month or two rather than more than that. So I don't think I don't think we're too far away.
It's interesting, Ben, because I talk to economists, and then I talk to market strategists. And when you talk to an economist, and I see you smiling, when you talk to an economist, it's all gloom and doom. The sky is falling. We're going to, this is going to be the worst thing ever. But when you talk to the market people, they're like, this isn't so bad. This isn't, I would assume you think a soft landing or even no landing is possible. But when you talk to an economist, it's terrible. How are we in such a different world?
I think there's a little bit of difference in perspective. I mean, market strategists are forward-looking. They're always asking, what's discounted in the market, where the surprise is going to come from. I think the perspective of the economists is a little bit different. It's a little bit more backward-looking. They're dealing a little bit more with the reported data, which by definition is lagging. If one's being flippant, the strategists are a bit more focused on the upside. The economists are a bit more focused on the downside. So I think perspectives matter, and we're coming from slightly different places. And I'm not going to denigrate the entire profession, but, we're also a little bit in uncharted territory, here with just, I guess, the hits at the economy. We're coming from, zero interest rates. We've had COVID. A lot of this we've never seen before.
So are you thinking, early fall for an interest rate cut, or first one, if there is one this year?
Yeah, so I think the market is broadly right that we're going to get one or two cuts, this year. I have to say, I don't sweat getting that right, and I don't think the market cares too much. I think the market just wants to know we've seen the peak, and the next move is down, and that's going to happen within my sort of forecast horizon of the next sort of 6 to 9 months. And I'm very comfortable that's going to happen. I think that's all you need as a stock investor at this point. And as I say, if I'm wrong and the economy does cool here more, I do think we have this Fed put. The Fed can cut interest rates, more aggressively than we think on the one side. And on the other hand, I think what the market is not ready for is the Fed to actually say that it's not done, and there's more interest rate hikes to come, and inflation isn't controlled. And I think that's off the table as well. But, that I think is the bigger risk here. It's not that, inflation's just going to sort of roll over and the Fed's going to, cut more aggressively.
Are we seeing a little bit of a divergence where the market doesn't really care all of a sudden if there's cuts or not, where there's obviously, other than the NASDAQ, the Dow, the S&P, and the NASDAQ will come back. I think that this is end of second quarter profit taking, and I'll ask you about that. But is there a divergence here between, people worrying about interest rates and investing? The market seemed to hinge on everything the Fed said, but now it's like, okay, you know what? We're kind of used to this. We expected one at the end of last year. We're not getting it. Forget about it. We'll get it when it comes. Let's just go about our business.
I think that's broadly right, as long as the door is still open to rate cuts. And I think that's basically the environment we're in right now. I think the investment implications of that are much more at the sector and thematic level than they are at the stock market level. So tech is doing very well right now because it's not very interest rate sensitive. It has its own sort of AI-driven sort of growth story. That's a big sector, especially in the US. It's powering the market. What's not powering the market is everything that's interest rate sensitive, which had a very good start to the year when we thought we were going to get 6 or 7 cuts, and has now been, given it all back. because we're now only looking at one or two. So, small cap, real estate, financials, all these industrials, all these other, bigger segments of the market have, lagged significantly. That is where I think you're seeing that, interest rate debate playing out.
Is it irrational that the market, with the economy slowing a little bit, and the market doing so well? I remember the last presidential election we had, where Trump said, "Well, if Biden's elected, the stock market's going to crash, and if I'm elected, we're going to do really well." It seems to be we wouldn't know because Trump didn't get elected, but the stock market did quite well under Biden, and it continues to do well even though the economy is slowing. Is that an anomaly, or it's clearly possible, but it's strange that that's going on.
So this is certainly an idiosyncratic sort of earnings cycle. Earnings are accelerating. The earnings recession is over. We grew earnings nearly 8% last quarter, and I think that number is just going to keep building from here at the same time as the economy is probably going to keep slowing. And so, that's been food for the bears, and it's where the bears have been wrong. And why have they been wrong? I think they've been wrong for sort of maybe three reasons. One, AI and big tech, which has its own story, which really has nothing to do with the broader economy, the AI adoption story. Two, the impact of lower inflation on corporate profit margins. It's taken a lot of the pressure off. It's let corporate profit margins sort of expand, and expectations were pretty low. And so I think all that has swamped and offset, basically very little top line revenue growth. And that's why I say this is sort of an abnormal, maybe a lower quality earnings, recovery. But I do think, that top line story will come. Maybe not in the next few quarters. We're going to have a bit of a slowdown first. But, as the Fed cuts interest rates, those are the ingredients for that top line acceleration going forward. But, earnings are fine in the meantime.
Yeah, I want to ask you about Nvidia, and I had mentioned end of second quarter profit taking. Is that what you think is going on here? I mean, after the stock split, it was up about 17%. Now it's below where the split was. Certainly, I don't think any AI is going anywhere. I think it's going to continue to be a big story. And Nvidia will come back. But is that what we're seeing here? Do you think in tech?
Yes, I think this is a bit of an overdue sort of indigestion, pullback, call it what you will. But, let's have some context here. If you annualize, we're almost at half year so far. If you sort of annualize that, this is the best year for the S&P 500 since 1995, which was also the year we saw the most number of all-time highs. And we're annualizing, not too far away from that. So, the performance has been pretty spectacular. And we've seen one pullback so far this year of sort of 5-ish%. Your average year sees 3, and your average year sees also a intra-year drawdown of 14%. And we haven't seen anything close to that. So, different ways of coming to the same thing. Markets don't move in a straight line. We've had a very good year so far. I still think we're going to continue to have a good year, but, we're going to have some volatility. Whether that's traditional summer seasonality, whether that's the US political calendar starting early on Friday with the first presidential election, whatever it is. So, markets aren't going to move in a straight line. We're going to see some volatility, but I think crucially, this is a very fundamentally driven rally. Earnings are, moving up. The economy is doing well. I think valuations are well supported. So if the pullback comes, and it will, I think crucially it'll be bought rather than sold.
So you don't think we're going to continue to do well? The rally is still going to continue. Do you think that people are just a little tired of AI? I don't think it's a fad. I don't think it's going anywhere. But it seems that when all the talk is Nvidia, people are watching one stock and they're equating the hundreds and hundreds of stocks that are in the market, or thousands even, to one stock. They're all looking at Nvidia, and that's the way the market goes. Are we just not looking at it the right way?
Well, okay, so I'm going to contradict myself. So this has been a very fundamentally driven rally, right? Nvidia's earnings are up, revenues are up 240% last quarter. In some ways, the stock's just moved up with the bottom line earnings. That being said, the level of concentration is very high. The Magnificent Seven is, nearly a third of the S&P 500. It's, briefly it was the world's biggest stock. There've only been 12 of those historically in the S&P 500. And if you cast your mind down that list of, who used to be the world's biggest stock, it's slightly sobering. It tells you that, you don't stay there forever. You do get competed away. You do stumble. I mean, it's, AT&T, Cisco, IBM, DuPont, GM, General Electric. It's a real list of how the mighty have fallen. Now, I'm not saying that's going to happen to Nvidia, but it is a little bit of a reality check that, a 3.3 trillion company, which is up 140% this year, that's not going to happen again. Period. This is not going to be a 7 trillion company this time next year. So this is a long-winded way of saying, I would like to see this rally broaden. I fully expect it to broaden as interest rate cuts come, as economies sort of maybe stabilize in the US, accelerate in the rest of the world. I think these more economically sensitive, interest rate sensitive, sort of cheaper sectors and bits of the world will perform a lot better. And tech will be fine, but I think the leadership will change. I think that will be welcomed by most people as a sort of healthy event. And I think that's probably going to be the story for the second half of the year.
I want to touch on energy for a minute because we do need energy to power AI. And we saw the same thing, and there's been a lot of talk about it. Look, we need data centers. We need power to power this. They're talking about uranium and all this stuff to power the AI that we're all going to use. The question becomes, we saw the same thing in the dot-com bubble. Oh, everybody's going to need a computer. Everybody's going to be on the internet. We need the power. But then that sort of, there was that peak and then it kind of dropped off a cliff. Are we looking at the same thing here as far as power goes for AI?
So we're certainly having an explosion of data center activity. It's helped make utilities, surprisingly, one of the best sector performers, so far this year, despite being perceived as defensive, despite as being sort of rate sensitive. It's done very well. The International Energy Agency is out there saying that data center demand is going to go from 2 to 3% of total electricity demand to sort of double that over the next 2-3 years, which is basically a new Japan. That, ChatGPT uses 10 times as much power for a search as Google does. So there's all these sort of supportive stats out there. So I think, that demand is coming. I think what we miss is a couple of things. So one, there will be efficiencies, along the way. There will be new ways of doing things along the way. I'm not sure we can just extrapolate things forward, A. And B, in terms of the market impact, I think, just going back to your dot-com sort of analogy, where we got it wrong in the dot-com was on the valuations, not on the fundamentals. Basically, everything we said on the fundamentals of the internet becoming a thing and taking over the world and driving revenues and everything else all happened. We were just grotesquely overpaying for it. Cisco 110 times, if that's your Nvidia comparison back then, Cisco peaked at 110 times price earnings ratio, and it's never recovered, even though revenues are up 7 or 8 times. So the revenue's delivered, but the valuation was wrong. And that's what's different sort of this time round. I think AI has moved from hype to reality. You're seeing that in the numbers. And we're certainly not overpaying for it yet. I mean, Nvidia, which is the sort of poster child, is 45 times PE? Absolutely not cheap, but neither is it on those, stratospheric valuations we saw back in the dot-com boom and bust.
Is there other sectors that you guys are keeping an eye on that you think will be up and coming or doing really well? Look, energy has been doing really well, quarter after quarter. Are there other sectors? We know that there are some sectors that are lagging, that are not doing as well. So it's, and I've made the analogy where, you could say that some sectors of the economy are in a recession, but some are really doing well. So you almost have to look at it sector by sector. Are there other sectors you guys are looking at and evaluating and say, maybe this is up and coming, or maybe we're onto something here, or maybe this is going to drop?
Yeah, so I think there's two angles there. So one is the sort of secular growth theme, which is all things related to AI. I think the AI, when we're in the early innings, all the focus on the picks and shovels, like, Nvidia right now. But over time, as adoption builds, as the use cases get developed, that will absolutely broaden out. And that will go across the rest of tech into software. It'll, deepen into utilities. It'll go into industrials. It'll broaden right out. That's one. The other one, and I sort of touched on this earlier, is basically all the assets we've forgotten about in the last 10 to 15 years. So, places like Europe, places like China, sectors like, industrials, financials, real estate, these things that are interest rate sensitive, are economically sensitive, and are trading on much cheaper than average sort of valuations. I think as we move into the second half of the year, as we get this economic pickup with lower interest rates, I think you're going to get a big sort of cyclical pickup and revisiting of some of these sectors, which many people haven't looked at in a decade.
Before I ask you about oil, the numbers that are coming out this week, consumer confidence, are there any expectations? Are you guys thinking, these are going to be good numbers? The PCE, the jobless claims, those sort of things. What is the outlook? Do you guys look at that and say, okay, here's where we think it's going to come in?
Some of this, I think, is on autopilot. So I think the consumer, which you're right to focus on because it's the engine of the US and many other economies, I think is in healthy shape. We're seeing real wage growth. We're seeing 200,000 new jobs, but there is some stress under the surface. So I fully expect that to keep slowly easing, and unless we get a big downside surprise, I think that trajectory is sort of baked. But again, that's the driver of the US economy. PC inflation is the most important number in markets. It drives everything from the interest rate outlook through to the recession risks, through to what valuations we're going to pay on markets. So PC's been a lot better behaved, and it's calculated differently than the headline number. But I think we're looking for another number below 3%, and I think that is enough to keep the door open to rate cuts this year, which again I think is all that's needed. I think there's some big technical numbers. Just Friday's also the FTSE Russell rebalance, which is probably going to be the biggest volume day of the year in the US. So I think those are the three or four things we're watching. Well, this week, sorry, the other thing that's happening on Friday, I think, Thursday is the first presidential debate, which is coming much earlier than expected. And I do think that's going to be a source of volatility through to the election.
It's a thankless job being Fed chairman and being a Fed governor. Do you think that they've done a good job? It seems that they've done okay. Inflation was at 9%. Now it's creeping down a little bit below 3%. They want to get it to that 2%. Do you think they've done a good job here?
I think they've done an okay job. To your point, thankless task, and they're dealing with an unprecedented situation. I wouldn't want to give them too much credit for bringing inflation down to here. I'm not sure the tightness of monetary policy has had an awful lot to do with that. I think a lot of this has been supply chain normalization and a big pickup in US productivity, but I'll certainly give them some credit. But I think job is half done. They need to, it's the last hard yards, that last 1%, A, and B, they've still got to thread that needle of getting that timing right and engineering that soft landing. So I don't know. I'd probably give them a B+, maybe B+.
I was, when you were about to say it, I was like, hey, he's going to go with about a B here. So I guess we're on the same page. Ben, what about the deficit? I mean, we're looking at over $35 trillion. I think within the next few days, there's another bond auction, the 2-year, the 10-year, I believe, maybe even a 5-year in there. And the prices are in the upper 4s at this point. So if you're on fixed income and you have money put away, you say, okay, maybe this isn't so bad. I know what I'm getting. But there's going to come a point where these bond auctions are going to fail because they need to raise so much money. And this is going to be a huge problem for us.
So it's a problem. I don't think it becomes a market problem until it does. And that sounds flippant, but, the absolute numbers are not too terrifying. US debt to GDP, 120%. There are plenty of places in the world, most of Europe, certainly Japan, that have much higher numbers than that. But to your point, I think it's the direction of travel that we're running that sort of deficit, 6% of GDP when the economy is frankly booming. And you don't normally see these deficits outside of, recession. So that's a concern. And B, we're about to go into an election. Neither candidate is addressing this. Well, neither party, neither Congress is addressing this. And what this means is that ultimately the market will address it, and the bond vigilantes will see a comeback, and they will address it. The struggle is, is that tomorrow or is that in 10 years' time? I can't answer that, but I definitely think it's one of these sort of tail risks you need to be thinking about, and it's absolutely a government problem. I mean, we've basically seen corporates and consumers, deleverage over the last sort of 5 to 10 years. It's government is the one that's still there with its checkbook open, and again, if they're not going to close it, the market ultimately will close it for them.
I find myself wanting to ask you which president or which candidate is better for bringing this deficit down. But it actually, Trump started the spending, Biden continued the spending. We had COVID in there that forced us to spend a little bit more. So I don't think either candidate is going to put the checkbook away and say, "Oh no, we have to deal with this" at this point.
I think that's absolutely right.
So let's talk about world events, I guess, and the price of oil. A few weeks ago, it was around $75 a barrel. Now it's just under 82, I believe. I think that's a good range as long as it doesn't pop above 85. But given the geopolitical environment we're in, do you see oil becoming a problem? And I know that that's one thing that can trigger a recession is high energy prices. What are your thoughts on the price of oil, where it could be going, and the geopolitical situation?
So I think these are good prices for everybody. I think if you're an oil company and Brent's at $85, you would never say in public, but these are fantastic prices for you. And if you're a consumer, I think anything below $90 you can sort of live with. We've seen, though, when oil goes above $90 Brent, how quickly consumers and industrial users sort of really respond. So I think we're sort of stuck in this range. The global economy demand is sort of recovering. I think that puts some upward pressure on prices. But users have shown us how sensitive they are to higher prices. And OPEC's sitting out there holding back 5% of demand, 5% of supply from the market. And I just think, the higher prices go, the more you're just going to see this sort of splintering of OPEC. So I guess I'm in this camp of sort of high but not higher prices. And if we do go higher, it sort of becomes self-correcting because OPEC sort of begins to splinter a little bit, and some of that production, some of that supply comes back, and demand, we just see, consumers driving less, and we drive that sort of renewables transition even faster.
Yeah, we are in the summer driving season, but it doesn't seem that the gas prices here, and as oil goes, gas prices, as soon as you hear about an uptick in oil, even though that price doesn't hit the market for a while in terms of gasoline, because it has to be refined and all that, it just seems, oil went up, yeah, we're going to raise gas prices. They beat the market in that respect. So I don't know, and I leave it up to you guys as the experts, as where you think gas prices will go and oil prices are headed at this point.
Listen, it's certainly something that keeps us up at night. We're in this stickier inflation environment. The last thing we need is a spike in oil, or, to your point, a spike in consumer inflation expectations. And this is the one variable because, we drive past it. We drive past the gas station every day, and it's literally up there in sort of flashing lights. That correlation is very tight, and the politicians know it, which is why we're talking about potentially selling more out of the U.S. Strategic Petroleum Reserve, even though there's almost nothing left, because we're into election season, we're into the driving season. Gas prices matter, so I do think it's going to be self-correcting. I don't worry about it too much, but it's one of these variables that I think we need to be sort of humble around.
And I know that here in the U.S., it's a lot lower than what you guys are paying per liter over in the UK for sure. So I guess we have to count our lucky stars. I want to ask you about the presidential election a bit. Obviously, we mentioned the first debate coming up this week. What are people saying overseas? What is the view overseas about all this?
People see it as very important, and I think rightly so. We have had a year. I mean, this was always going to be the year of elections, and it's really lived up to that. We've had a lot of surprises: India, Mexico, France, South Africa. Most of those negative surprises, and And I think that makes us even more healthily concerned about the US. And I think the reason we're concerned about the US, it's 65% of global equity markets, not too far away, that sort of dominance of FX markets and bond markets. So, it's completely supersized. Anything that happens in the US, reverberates around the world. It's going to be a very tight election if you believe the polls. And there are significant policy differences, I think, between the candidates. And with the first debate starting on Friday, this sort of political race, at least in terms of the consciousness of the average investor or average voter, is starting earlier. So I think at a minimum, this is going to drive an increase in volatility, over the summer. I would hope that ultimately it doesn't derail markets, that these are the two best known presidential candidates basically in US political history. So I would hope that markets are a little bit sort of forearmed and prepared for sort of what's coming. So I guess I still see the glass as sort of half full. I think we're going to get some volatility, but I don't think it's going to derail the market.
So I want to ask you about cryptocurrency before I leave you. I know you guys are into cryptocurrency. We saw it, earlier in the year, it was probably around 26,000, around that number. It jumped over 70,000. Now it's right around 60. It's the volatility that you're talking about, but that's the nature of cryptocurrency. Where do you see this going? And, it's not going anywhere, but at this point, I guess it trades like an equity. And there is possibility of cryptocurrency becoming more mainstream?
I think that's the long-term story. And I think if you're bullish, that's why you're bullish. This is, the youngest, smallest, and most retail owned of all the asset classes. And if you believe, as I do, that we're at the early stage of this sort of gradual adoption cycle, that should drive value over time. We've seen the Bitcoin ETFs this year. We have the Ethereum ETFs coming. We've had the Bitcoin halving. We have a number of sort of institutionalization sort of landmarks coming. We have regulations coming at the end of the year, which are going to make it easier for US companies to own crypto, and basically none of them do today. We have global regulations coming, making it easier for banks to own crypto on the 1st of January next year. So I think all this is just part of this gradual institutionalization. So I have absolutely no idea where crypto is going to be over the next, days, weeks, months. But I think that long-term story remains very positive. And despite all this volatility, it's the best performing asset class last year. It's the best performing asset class this year. You need to manage that volatility. Diversification is the only sort of free lunch in finance, and that applies in spades to crypto. But I think the long-term outlook remains pretty positive.
Obviously, all these things you mentioned are vehicles and avenues for crypto to be adopted as a currency, if you will. Is you see it getting there? Obviously, you're bullish on crypto, and you think it's going to get there, but it's going to be a few years, if not longer, down the road.
I think this is always two steps forward, sort of one step back. But I do think you've had a big step forward this year. I mean, the Bitcoin ETFs, which make it easier for people to own crypto in the world's biggest capital market, as we just sort of talked about. You've seen 15 billion of inflows into Bitcoin so far this year. That's going to come for Ethereum. You've had, sort of orange lights given by the SEC. So I think that's fully coming. And as I say, I think you have a lot more of these catalysts still to come. Companies basically don't use crypto today. The regulations will make that easier. Banks have been very nervous. I think that will change. Ultimately, I think you'll see a central bank confessing to owning sort of Bitcoin as part of its sort of currency reserves. I think gold is 15% of global currency reserves, right now. So I guess what I find, again, Bitcoin's been around, or crypto's been around for only 10 years. This is a tiny asset class in global perspective. It's dominated by retail investors today. I just think there's so many different avenues that this could sort of develop over time.
Well, Ben, thank you so much. To sum up, it's hang on to your hat. We're due for some volatility, but you think the markets will do well for at least the rest of this year?
I do. I think this is very fundamentally supported. The twin pillars here: earnings are recovering, rate cuts are coming, and there's a lot of cash sitting on the sidelines that missed the start of this rally. I think we're in the early innings of a bull market. The average is 5 years, 150%. Well, what, a couple of years in? I think, and again, I think this is very fundamentally supported, and we have a long way to go.
Thank you so much. Ben, where can we find you on social media and read more about your work?
Sure, so you can find me at eToro.com or on Twitter, Ben_Laidler.
Excellent. Ben, thanks so much. Appreciate having you, and we look forward to seeing you again soon.
Fantastic. Thank you.
That's a wrap on another discussion here on Wealthion. Thank you for joining us. If you need help being financially resilient, please head over to Wealthion.com. Sign up for a free, no-obligation portfolio review with one of our registered investment advisors. And remember to follow us on social media for the latest news and information to help you invest wisely. If you could like and subscribe to the channel, we'd greatly appreciate it. Don't forget to hit the notification bell so you can find out when we post new videos to the channel. Thanks again for watching, and until next time, stay informed, be empowered, and may your investments flourish. And if you like this content, please watch this video next.